And now we turn to the ranking member from Massachusetts, Mr. Lynch, for his questions for 5 minutes.
Thank you, Mr. Chairman. Again, I thank the witnesses. Professor O'Neill, so I was here when we created the CFPB. I was here during that debate. And the goal here and the statutory direction for the CFPB was we were trying to provide a single point of accountability for enforcing federal consumer financial laws and protecting consumers in the financial marketplace. Why would this proposed rule be outside of the regulatory framework that we set up for the CFPB? This is exactly, in my mind, this is exactly what we created the CFPB for. We understood, even back then, not that long ago, that technology was changing. We understood that, so we didn't put limitations on technology for the CFPB. We said protect consumers in the financial marketplace. Full stop. Full stop. So now technology companies are getting into the financial marketplace in a big way. $300 billion so far in peer-to-peer apps and other platforms. So why explain to me why the CFPB would not be that would not be in the legitimate purview of their regulatory mission?
Thank you for the question. I think that regulating this space is absolutely within the CFPB's jurisdiction, and I view it not so much as the CFPB trying to regulate tech firms, but as the CFPB exercising its authority as directed by Congress to regulate, and in this case, to supervise non-depository institutions, non-banks. It just so happens that these non-banks often bill themselves as tech firms, or the term that has become so popular, financial technology companies or fintech companies. And this point about digital payment firms having to abide by the same laws, the Electronic Funds Transfer Act, the Gramm-Leach-Bliley Act, but not in the same way that banks do with respect to supervision, I think really accentuates a divide between banks and non-banks, or shadow banks and banks, which remains an issue even after the 2008 crisis. I think we saw this most significantly in the run-up to that crisis, where banks, chartered institutions were subject to one set of rules, and non-banks, which was largely the engine of subprime lending, were not. And I think it's worth saying what I mean by not subject to the same set of rules. That's really along 2 dimensions. First, they don't have the same sort of safety and soundness requirements that banks have. The result is that their business models can come in a form that requires very few reserves, also very thin margins, which makes them vulnerable to shocks, which in turn can trickle down to consumer harm. And then supervision being the other side of that. These firms generally, while they have to abide by the same rules, they're not subject to the same monitoring.
I got to jump in here. No, I appreciate that. So I've heard from other witnesses that there's no risk-based foundation for the CFPB to act. But of the 24,000 cryptocurrencies that have been launched, over half, 14,000, have died. So people have lost their investment completely. Those cryptocurrencies have gone dead, gone to zero. So we know there's an abundant, never mind, FTX, Mixin, Aeron, Terra, Paycoin, BitConnect, that have all gone to zero. There's a huge amount of risk and volatility in that, and yet there are some who say there's no risk-based reason for CFPB to venture into this. And let me just ask you this last question. So if I set up a banking system that has all of the bells and whistles, all of the banking regulations for one group, and then I create another one that has no regulations, completely unregulated, where is the money going to migrate in your estimation? Where will the money migrate and the financial activity migrate to? The heavily regulated one that protects consumers, or the fintech area with no regulation?
I think quite simply, it will migrate over to the non-bank area because there are lower regulatory burdens in that space. But the trade-off there is that there can be more consumer harm in that space because there is less watching of the players in that market.
Thank you. I yield back.
Gentleman yields back. Mr. Lucas of Oklahoma is recognized for 5 minutes.
Thank you, Mr. Chairman. The U.S. banking sector is among the most highly regulated sectors in the country. And in 2010, the passage of Dodd-Frank unleashed more than 2,000 pages of sweeping reforms and new regulations across the industry. Dodd-Frank also established the CFPB, giving the new regulator broad authorities over banks and non-banks. Part of this authority was supervision over the larger participants in consumer financial markets. CFPB's proposed larger participant rule from this past November is the 6th rule in this category, this time aimed at digital consumer payments applications. This rule would allow the CFPB to supervise certain non-banks that provide money transfer services to consumers. Mr. Holshouser, let's talk about some fundamentals for a moment. You discussed in your testimony how CFPB does not follow the Administrative Procedure Act. Can you expand on that? So that's one of the fundamental issues, playing by the rules.
Well, there's a statutory rulemaking process that has to be followed, including plenty of time for respondents. I think that 60 responses were heard in this case in what really was 41 days. If you include all the holidays, it was supposed to be 60. They also have to provide a justification of consumer harm and a reason for why they need to do this. And they need to explain who's going to be regulated and how it's going to happen for a response. Just to quickly answer so you can have it back, that's in and of itself not sufficient.
Mr. Kim, this isn't new for CFPB. Could you highlight the importance of a robust Administrative Procedures Act process? Why does it matter?
It matters because the agency does have a lot of power, and in order to exercise its power, it should follow its statutory mandate in Dodd-Frank and other acts, but primarily in Dodd-Frank. And so I think, in order to have the right balance of executing its mission to protect consumers, exercising its broad regulatory powers, it has to follow the mandate from Congress.
There's been a significant amount of questions regarding the details of the rule. For example, the CFP does not clearly define the term funds. And there's concerns that this could rope in entities that transfer assets such as securities or even commodities that are outside the purpose of this rulemaking. Mr. Kim, could you explain how elements in the proposal such as this are overly broad?
So Dodd-Frank has a specific requirement, or really, I think boundaries is the better word, saying very clearly that the CFPB's jurisdiction ends where the SEC and the CFTC's begins. So I think it's pretty clear that those two sister agencies have been very active in the digital assets and crypto space, and so the Bureau should, I think, respect and recognize the jurisdiction and the effort and the investment by those agencies and Congress in the digital asset space.
Mr. Johnson, could you offer your perspective on the far-reaching nature of the proposal? This has long-term impacts.
Yes, Congressman, it does have long-term impacts, and I think the impacts will manifest over time due to the confidential nature of the supervisory process. So an overbroad market definition, an imprecise establishment of the asset threshold for determining larger participants mean that an unknown number of institutions will be subject to supervision. As a confidential process, the public won't understand what the Bureau does behind the scenes afterwards, and I think that's the primary risk.
Focusing in on the requirements under the proposal, does the CFPB outline any specific examination procedures for larger participants offering covered payment services? And I'll direct that again to you, Mr. Johnson. Please give us a sense of what details the CFPB lays out in my remaining time.
The only reference I'm aware of is the general statutory requirement that the supervisory process itself be risk-based, Notably, the rule is not risk-based, and the Bureau's determination of the market and the institutions subject to the proposed rule is not risk-based.
With that, Mr. Chairman, my time's about to expire. I yield back.
Gentleman yields back. The ranking member of the full committee, Mrs. Waters, is recognized for her questions for 5 minutes.
Thank you very much to Professor Adeniyi. The misleading title of this hearing suggests that the CFPB's larger participant rule would restrict competition in payments. But if anything, this rule should increase competition by ensuring that the largest companies are not able to leverage their size and data to unfairly crowd out smaller companies. This is a concern because some of these big tech companies do not have the best record when it comes to consumer protection. Meta, for example, has engaged in illegal data practices and has been a repeat offender of regulatory orders, highlighting the importance of supervisory authority in this space. Can you talk about how this rule would help smaller companies by keeping the biggest companies in check?
Thank you for the question. I agree with you that market dominance is a real concern in the non-bank payment space. The dominance and the concentration of the consumer payments market by a handful of companies poses, I think, some significant dangers. We know that when a small number of companies control the majority of the market, that does limit competition, leads to higher prices, and of course to reduced innovation. Also, lower income households facing financial constraints may be disproportionately affected by having fewer alternatives and of course are more vulnerable to those price increases. Also, market dominance can stifle diversity in the consumer payment space by limiting access to services that are more tailored to the needs of specific demographic groups. I see this rule as being in service to addressing that market concentration. So to give you an example, the CFPB, with supervision authority in this space, could monitor instances of unfair and deceptive acts and practices by non-bank payment firms that make it more difficult for consumers to untangle themselves from their payment account relationships and thus move on to other providers that might be more optimal for their uses.
Thank you, Professor. Can you also speak to the broader concerns about the potential for monopolistic use of data and misuse of market power by big tech companies? How concentrated is the market for payments currently, and what risk do you foresee in the absence of enhanced supervision by the CFPB under its new proposed rule?
So some of the empirical data right now indicates that a vast majority of U.S. households use just a few of the major payment platforms. I think I saw 56% of U.S. adults use Venmo and PayPal. So that's a great deal of concentration. And I think that level of concentration and the way in which it generates very sensitive consumer financial data raises really significant concerns, particularly relative to privacy. I think this rule is animated by that concern. We know that major tech companies build their business models around the large collection and analysis of user data, like browsing histories, social interactions, and search inquiries. Having this payment information helps build even larger stockpiles of data about consumers, which, held by just a few companies, can be very powerful in, as I mentioned in my earlier remarks, unlawful price differentials as well as targeted marketing.
Thank you so much. Mr. Chairman and members, I served on one of the conference committees of Dodd-Frank. I was so happy that consumers finally had an agency dedicated to taking care of their concerns. And so, Mr. Hill has said it has been controversial. Controversial because the opposite side of the aisle did not like the idea that the consumers were now going to have influence and power. So I'm very thankful for the hearing, although it is entitled in a misleading way. But this brings out what the CFPB is responsible for, what they should be doing, and it does not continue to have to take certain kind of criticism from the opposite side of the aisle, who never liked the Consumer Protection Bureau. Thank you, and I yield back.
Gentlewoman yields back. Mr. Rose of Tennessee recognized for 5 minutes.
Thank you, Chairman Hill, and thank you for our witnesses for being here with us today. Recently, I was made aware that on February 23rd, 2024, my birthday, incidentally, the Consumer Financial Protection Bureau disclosed that a company had made the decision to challenge an order that sought to establish supervisory authority based on, quote, risk determination, close quote. Director Chopra has described the agency's authority as the ability to decide that a company is risky and subject it to supervision through its statutory authority. Mr. Johnson, are there any meaningful considerations the CFPB is required to make before determining a company is risky, or has the CFPB set this up as an arbitrary process where they have near unlimited discretion?
The standard of evidence that the Bureau has established through its procedural rule is quite low. And the real problem here is that the Bureau changed its procedural rules to make non-public confidential processes associated with the supervision of institutions public in one instance and one instance only, and that's where the company challenges the proposed determination. So this creates leverage for the agency to say, we want to supervise you, and if you fight us on this, then we're going to publicly name you as having challenged that proposed designation and subject you to, among other things, class actions and reputational harm.
Thank you. One of the factors that the Consumer Financial Protection Bureau's proposal uses to determine if a non-bank covered person would be included in the general use digital consumer payment application space is whether they provide at least 5 million covered transactions annually. Several market participants have indicated that this threshold is alarmingly low. Mr. Holzhauser, would you describe the potential market impact if the CFPB categorizes entities with such a small market share as larger participants?
So the minimum 5 million transactions is alarmingly low. If you think about just some of the small to medium-sized businesses having tens, if not hundreds of thousands a day, that threshold is so low, it's obvious that it's an attempt to increase the purview of oversight of the CFPB, which will, as I mentioned earlier, have outsized effect on startups and small and medium-sized companies who are trying to innovate and grow, and disproportionately affect them.
Thank you. Appreciate the insight. Mr. Kim, how has the CFPB historically determined thresholds for identifying entities to be considered larger participants under the larger participant rulemaking?
In the past, they have conducted, data-based research that's specific to a very well-defined market, and so there hasn't been, I think, the uncertainty that there is today with this rule. So, for example, with credit reporting, that's a very well-defined market. So I don't think there was a lot of debate or discussion or uncertainty about, what is large in that market. Same for a lot of the other LPRs. I think today's hearing, highlights the uncertainty with this particular LPR.
In your view, Mr. Kim, did the CFPB conduct significant analysis to arrive at the threshold in the proposal?
I don't see it in the proposed rule. I can't tell you what their basis was for 5 million. I can say that very anecdotally, there are, as Mr. Kohlhauser said, smaller to mid-size payment companies that would easily meet that threshold within a matter of months.
Shift gears a bit. Mr. Johnson, in addition to the larger participant rulemaking, the CFPB is attempting to create a non-bank registry. I signed a letter that my colleague, Mr. Ogles, led in May of last year, highlighting our concerns with these actions by the CFPB. The CFPB has justified the need for a costly registration system where non-bank companies, quote, self-report public orders like enforcement actions or consent orders so that consumers can be on the lookout for repeat offenders. Mr. Johnson, isn't this information already public?
It is, and other aspects of that proposed rulemaking are equally troubling.
And I see my time has expired, so I yield back, Mr. Chairman.
Gentleman yields back. Mr. Sherman of California, recognized for 5 minutes.
I, too, would like to criticize the CFPB. It has taken them over a decade to come up with a rule defining who would be subject to some future rule. While consumers need the protection now, we may get it in several more years. This initial pre-rule is long past due. Been in this town for a long time, and I've snuck in at least once to lobbying 101 secret classes. The rule is very simple, but the teaching is simple. If the facts are on your side, argue the facts. If you're on the side of good public policy, argue the public policy. And if the facts are against you and the public policy is against you, argue the procedure. And that is mostly what we have here. People telling us that the procedure is somehow off. Now, the most extreme of those arguments is to have the cryptocurrency industry come in and say how god-awful, outrageous it is that somebody would treat crypto as a currency. If you aspire to be a currency, you should aspire to be regulated like a currency. And like our ranking member, like the chair, the ranking member of the subcommittee, I was here for Dodd-Frank, and I can assure you that when we said funds, we certainly included anything that qualified as a currency. Banks have long not really enjoyed the Community Reinvestment Act, and so the high-tech companies have decided, well, if we can be a bank but call ourselves fintech, then we don't have to live with the Community Reinvestment Act or a host of others. Mr. O'Donnell, okay, PayPal is holding on to, I think it's about $18 billion of customer money. I assume that they invested as they will, maybe safe investments, maybe speculation. If they go bankrupt, does the FDIC reimburse the customers?
Thank you for the question, and the simple answer is no. Those customers are holding their funds with a relationship only to that non-bank intermediary. The FDIC insurance.
So it's like loaning money to your brother-in-law if your brother-in-law is Sam Bankman-Fried.
Yes.
Okay. I'll ask Mr. Holschenauer, representing TechNet. If one of your members goes bankrupt, will the other members chip in and make the customers whole? Or will those customers, voters, be here demanding that Congress bail them out?
Well, it depends on what side of the fintech industry you're speaking of. You know, there's zero liability for credit and debit and other products, but there is some exposure.
Well, you've got right now they're holding on to $18 billion. They are investing it in either something safe or maybe pork bellies. I don't know where they put their money, and wherever they put it today, they could have put it somewhere else more risky tomorrow. Your members aren't going to bail them out. They're going to be here demanding a bailout from Congress. I'll point out that the deal with Venmo is that you pay 1.75% to get your money 3 days earlier. I don't think APR is really the way you should evaluate this, but for those of you who are fans of annual percentage rate, that's charging the consumer 213% annual percentage rate. Yes, it's only 1.75%, but that's just for 3 days instead of for 365 days. So we have a situation, Mr. Ogundeh, I can't think of any other situation where ordinary Americans put their money in a financial institution that is totally unregulated, allowed to invest their money in pork bellies or mongoose coin or whatever they want, and they have no insurance. Can you think of any other place where millions of Americans have their money at that kind of risk, where they deposit their money and they think it's there?
No, nothing comes to mind. But to your point, I think a real danger of the way consumers interact with non-bank payment platforms, and I'll say this is also particularly true for crypto firms, is they do so under the misperception that when they do, they enjoy the same sort of regulatory protections they have when they deal with a broker-dealer and they invest in securities or deposit accounts when they deal with banks, which is manifestly not the case.
Thank you.
Gentleman's time has expired.